So today we are going to talk about overtrading. So what does overtrading mean? How does it affect us? So there are many kinds of overtrading. We are going to discuss each one of them one by one, and let us start with the first kind called overtrading by number of trades. Let us say we take about 2 trades per day. So that means there are going to be 2 buys and 2 sells. So this is generally what is considered as normal. Now suppose you take 200 trades per day, so that is over trading by number of trades. What happens if you do this? When you take so many trades, your view will have to be changed several times, and you lose track of which view was correct, which view you had previously, and which one have you changed it to now. So it will affect your ability to judge properly. It will affect your ability to take decisions. So whether to enter or to exit, to wait, or to understand whether the market is going up or down. So all these things will get confused. It will affect your ability to judge these things properly. So this is the first kind of overtrading that we need to avoid. So what is the solution for this? The thing is, before entering the market, you need to decide how many trades you are comfortable with and how many trades you are going to take. Something like this. So I'm going to take today uh, 1 trade. If I am profitable, I'll continue. Let us say we will you use what is called as pyramiding. So if the market is going as per your view, so market is going up, you entered a position here. Now it pulled back and made a move up again, so you pyramid here, and then again it made a move up again, so you would pyramid here. Okay, so let us say you do pyramiding. So you take 100 quantities here, you take 50 here, you take 20 here, and you see some pattern here and you exit. So this is your normal course of action. Let us say what we call in software engineering terms sunny flow. So everything is going according to your plan and you're happy. So this is how we would usually plan to take a trade. So before the market begins, I'll decide that I'll trade like this. I'll trade with 100 quantity, and if it goes into profit and there comes an opportunity to pyramid, I will take 50 more. So this is 1 buy, this is second buy, and this is third buy. And once I sense that the trend is going to change, I will exit all of those. So this is your trading strategy. So 3 maximum buys, 3 buys max, 1 exit. So this is like normal plan that you make. So this is sunny side. Now suppose you took 1 trade and it went into loss, not the break even, it went into loss, let us say. So that's when you will decide I will not trade unless there comes a very compulsive opportunity. The opportunity must force you to take trade, not that you force yourself to take the trade. The opportunity must force you to take the trade. Unless that happens, I will not trade. So 1 trade is what I'm going to do today. And for those who have more bigger heart, strength of the heart, so let us say 2 trades. I will not trade more than 2 losing trades. If you took first trade, you lost it, you took second trade and you lost it, close. You will not trade again on that day. So this is how you avoid over trading. So this is one. So let us now talk about over trading in terms of quantity. So suppose you have 1 lakh rupees in your account. and with 1 lakh rupees you can buy 500 quantity of any share that you want to trade in. Buying 500 quantities is over trading. Why? Because if it goes into profit, all good. If it doesn't go, I'll tell you what happens. Let us now consider a general rule to avoid over trading by quantity. So if you can take 500 quantity with the capital that you have, you should usually divide it by 5. 500 divided by 5, so that gives you 100, right? So let us say you trade with 100 quantity. Now the first trade went into loss. Say I lost 10 points. So what happens? My loss is 10,000 rupees. Sorry, 1,000 rupees. So this is your present running loss. Had you taken 500 quantity and you lost 10 points, your loss would be 5,000 rupees. So suppose you lost 100 points. To make the loss amount look big, what we'll do is we'll take a little bigger amount. So you took 100 quantity, you lost about 50 points. You took 500 quantity, you lost about 50 points. So at this point your loss is 5,000 rupees, whereas in the case of 500 quantity your loss is 50,000. So this is almost half of your capital. Your mind would be going crazy at this point, whereas here, because you still have 95,000 rupees left in your capital, it's a small amount, you will not lose your mind, you will be all fine. Maybe, although I would recommend that you cut position when this happens. If you lose 550 points, well, you waited too long already. So usually it will be about 5 points. If it goes against you by 5 points, you should exit it. But let us say you sat until 50 points. Now there is no need to wait, exit the position. So take a loss of 5,000, keep your remaining capital as it is. But if you take 500 quantity, if you exit, you lose 50,000 capital, which feels bad. If you don't exit, it might happen so that you would lose all of your capital. Basically you will blow up your account. Or if you take the full quantity, the speed at which your account's declination happens would be faster than the lower quantity. This is over trading. Now much better, safest would be you divide the quantity that you can purchase with your capital, divide it by 10, so that will give you 50. So trade with only 50 quantity all the time, every day. Every time you take the trade, do only this. But you remember the first rule of not over trading. You take limited trades per day, so that if something goes wrong, you still have your mind with you, you still have your capital with you, so that you can trade the next day. The other kind of over trading is trying to be in the trade all the time. You can't wait for a proper entry point, proper pattern to form, to see a set of signals, indicators. You can't wait. You take it because your intuition said you would take a trade, and then you would sit in the trade. Sitting in the trade, you will be looking at the chart and you will be making too many decisions, views, that this everything. So what happens is you would lose track of proper direction, where you are supposed to go or where market is going. So you would lose track of all that. So this should not be done. Do not try to take the trade the moment you feel like taking a position. Right? What you should usually do is wait for the market to give you an opportunity properly. What do you mean by a proper opportunity? there come too many parameters into consideration here. So a market made a pattern which is infallible, which is um, it, it can't go wrong. Well, no pattern is 100% perfect, but let us say there are some patterns which you observed in a particular stock that will work 7 to 8 times out of 10. When that kind of pattern forms, and also you probably use this MACD or the other kind of indicators, moving averages, that this. So a confluence of signals, okay, let me say it this way. So a pattern formed which would work 7 out of 10 times, so that is 0.1 point, and the MACD is indicating that signal is crossing from below to above, so there is another point, and the moving average is also showing that it has crossed, not it is willing or showing to cross, it has crossed, so that is a third point. And then your RSI is saying something, so that's another point. And the pattern that you're seeing here fits properly with the major trend, okay. The pattern, the time frame, the major trend, all are fitting well, okay. So that will give another point. So out of 5 you got 5 points for this trade. So there is somebody in the YouTube who speaks about 5 star trade, 7-star trade, some Madan is his name. So as per that person's philosophy, if you take a 5-star trade, that is a good way of taking trade. Instead of just running and taking position, wait for all these things to happen. All these confirmations combinedly will give you an opportunity that is compelling opportunity. Only then you will take a trade. Otherwise you will sit idle. So this is one kind of over trading and how to overcome it. Now we'll talk about the other kind of over trading under the same heading, wrong trades. Taking trades when no trades are supposed to be taken. For example, let us say market is ranging. Alright, so this is our range. Now you see, it is a falling channel, so you know that sometime or the other it will go above this, okay. So this is, generally speaking, it will happen, but the problem is when. So should you wait until that time to take the trade, or should you take the trade now and wait till that time, or should you take the trade when there is a clear cut breakdown, or and in this, so breakout I meant. So and there, in the breakouts there are two kinds: pass through breakout and there is resistance breakout. Simply let us call this as it consolidation. Breakout after a consolidation is called opposite of pass through breakout. So this breakout is very much genuine compared to pass through. It doesn't mean that pass through is a false breakout, it could be genuine too, but this is more genuine, okay. So should you wait until this consolidation breakout happens, or should you take when it just passes through the breakout, pass through breakout happens? So these are all the questions that you need to consider before entering the trade. But what do we do? you're not supposed to take trade anywhere here. So this is a no trade zone, what we generally call. But because we know the higher time, higher truth, that from a falling channel the price will always break up, right? So we'll take the trade. What happens with that? So you take a trade here, it goes a little high, you'll be happy. It comes a little low, you'll be um, tensed, you'll have frustration because it is spending a lot of time. And if it is options, your decay will be faster than the price drop. So all these things will make you more frustrated, and it will make you exit somewhere. Suppose it is a pass through breakout, it came back to retest and passed, the price fell back into the channel and stood for it it stood here for some time and then breaks out again. But you'd be so frustrated that at this point you might exit. So this is called taking the trade when there is no trade. So this whole zone is a no trade zone, but you take trade here because you know that it is going to go in a certain way. But the problem is, did you consider all the fluctuations that your mind goes through, all the frustrations, all the exhilarations, all the impatience? So will you be able to withstand that? I would say nobody would be able to withstand that. I mean, nobody should be able to. Nobody should do that. So this is a no trade zone and people take trade here. So this is one kind of over trading. The best thing is wait for, like I said, a compelling opportunity that the market provides. So that there is a confluence of indicators, and if you are experienced, you don't need to look at any indicators. You can simply say this breakout is good, let us enter here. Okay, now we'll go to the other thing that we need to talk about when we're talking about over trading everything. So market is going in uptrend, you take the trade, good, it's going according to you. But sometimes for some reason you think the market is going to go down, it will take a reversal. Now even though market is trending up, you will take the trade with the hope that it will reverse, and the reversal, market generally does what you think it will do, but it does it at its own will and wish, its own time. You can't withstand that. You can't wait until that time. So what you should do, you should take only trades at that point when the actual action happens. I'll tell you how to spot that later, but now let us consider. So market is supposed to go down today and you take the trade and the market is going up. Just that market will go down tomorrow, just not today. But your premium has decayed like crazy, that it's almost zero now. Now you can't exit, you can't stay. Now what you will do, you will usually exit and take a loss, or your account will be blown up by this point only. You'll get a margin call in a downtrend. So you took you shorted, all well, and sometimes it happens that you think market should take a reversal and should go up, and you take a long position, but the market is going down, you wait. Now this is a wrong thing to do. Now market is in downtrend, there is a rally, you want to capture this rally, right? Or market is in an uptrend and there is a dip, you want to capture this dip. So you want to do a short here, you want to do a long here, and there is a market is in ranging. So the moment it hits a resistance, you want to short so that it will come to the support, and you want to go long here so that you can book the profit here. So you want to do this, and normally many times what happens, see how confusing this is. Normally when the bottoms did not come back to the support line, it means it's going to go above this resistance level, but it did not really spend the time here. It did not really consolidate above or below this point, which means it's a pass-through breakout, which means it can come back and fall into the same range level again. And now it properly took a consolidation here, and then it gave the breakout. This is a genuine breakout where you should take position and make profit. But what we do, we take here, we take a short position here, we book profit. We take a long position here, we book profit. We take a short position here, we book profit. Now everything is going so well, so we are in a profit of 1 2 3 trades at 100 quantities. Now we took a short position here, and because we are in profit, we took, let us say, 300 quantity. Now you see it did not come here. Now you think it's just a glitch, it might go, you will wait, but what happens, it gives a break out in a wrong direction, so you are in a loss. So all the profit that you made in these three position is at risk, or maybe it's already gone and some part of your capital is also gone. You are at a loss here. But now because it has come back, now you'll think it will go back to the support level again, previous support level again, but it consolidated again. You could exit here, but maybe you're in a loss, maybe you don't have much profit, so you decide to wait. See, when you have taken short position, your mind will be biased very much towards finding signals that confirm the short nature of the market, even though it is consolidating here, which is a very good signal that it might give a break out. You would hope that it will go down, so that's wrong, and then you will take a loss. So all the profit that you made here is already gone here at this point, because you made a loss of 300 quantity. You probably have taken 500 here. Now you will lose more. So this happens most of the people. Now you trade the turning points. I'll tell you what the turning points are. So there is a fall and a hammer happened here. Because a hammer happened, you take a long position here. But what happens? The next candle will not break the high of this candle or the wick of this candle. It will be another red candle, and the next candle breaks the low of either this candle or this candle. Now you are in the fear and you exit. But when you're in the position, it came to this point. When you exited, the same thing went back and made a hammer here. So this will, at the end of the 5-minute time frame, looks like a hammer. So there was a hammer here, there was a candle, and there was another hammer here. Now, because you lost it, you will not take a trade here, and this candle goes above the high of the hammer. From here it will go. Okay. So turning point was this. So you try to take trades at every turning point with a proper confluence of indicators, so that will again disturb your mental faculties, so etc. So this is how the overtrading happens, and this is how you can avoid overtrading. A very simple rule to avoid or to do a proper trading is always wait until market gives you a compelling reason to take trade. Now what is that compelling reason? There is a clearly defined trend, there is a clearly defined indication in terms of candle, there is a clearly defined indication in terms of pattern, there is a clearly defined indication in terms of indicators, That could be MACD or moving averages or RSI or any which thing that you like. So like like I said, take 5-star trades, take 7-star trades. Now give attention to the confluence of the indicators. Only then enter the trade. This is the best way to enter the trade. You will trade very rarely, very rarely, but every time you trade, but the probability of you making profit will be higher. So that's all for this video. See you in the next one. Take care.